Hello, everyone. Thanks for joining and welcome back. Our guest today is a very good friend of mine, Adrian Day, the founder of Adrian Day Asset Management. Welcome back, sir.
Well, thank you for having me, Ivan. Good to see you.
Great to see you. I'm so grateful to have you come down to speak to the precious metals community. I wanted to get you down and talk about, all the excitement that's happening right now in precious metals, gold and silver, and of course, all the scary things going on in the economy right now. First, though, let's start off with precious metals. You were just at Beaver Creek. You were at the conferences in Colorado. We were just talking about this earlier before we started recording. What was the sentiment there? What are we feeling in precious metals?
Yeah, okay. Well, there's two big conferences, two big gold conferences that are back to back. One's at Beaver Creek, which is primarily for juniors, and then the second one is the Denver Gold Forum in Colorado Springs, which is primarily, but not exclusively, primarily the larger companies and the global companies. So I think the sentiment at both was very strong. Both of them had more people. Including on the issuer side. Beaver Creek had a lot more issuers want to come than they had room for, but both of them had a bigger attendance. Some of that, although perhaps not as much as one might think or hope, was from generalist investors, generalist funds, and so on, but really not as much as one would hope. But the mood was upbeat. I mean, how could it not be upbeat? And of course, it was upbeat. It was upbeat on both the issuer side and the investor side. And the mood was sort of infectious.
Nice.
Yeah, a lot of talk about, particularly at Beaver Creek with the smaller companies, a lot of talk about M&A. Now, I mean, every year that I've been going to Beaver Creek, every single year, the juniors, the explorers are saying, oh my gosh, I had so many seniors interested in my projects. We're going to have a deal done next week or by the end of the month. And it rarely comes. It's not, I mean, it should be expected that senior companies are looking at companies operating, exploring in the regions in which they operate. It would be perverse if they didn't look at what the explorers are doing. But having said that, this year seemed a different tone, to be honest, both from the juniors that might have properties, to option or to sell, but also, frankly, from the seniors. I think there is a hunger. There is a hunger for new assets among most of the seniors, not all of them, but most of them. And yet we are still avoiding the foolishness that we saw in 2011-12 when companies just overpaid for, let's say, marginal, that's a polite word, for marginal properties.
Hello, my silver and gold bugs. I just wanted to say thank you so much for watching the video. Hit the subscribe button, hit the like button, and also hit the notification bell so you don't miss any future uploads. Back to the video. Absolutely. Adrian, what's concerning you right now? What do you have your eye on other than, whether it is precious metals or whether it's in the financial, lowering interest rates, bond market, the debt bubble? What's concerning you right now?
Um, I think two things. One is, we're clearly entering a stagflationary environment. And maybe the economy is not as weak as it might be, and inflation is not as runaway as it might be. It's not runaway inflation at all. But I mean, I think it's clear, and I think Jerome Powell at the Fed sort of acknowledged as much yesterday. We are entering this stagflationary period where, as he put it, there's no risk-free route going forward. So, I mean, one concern for the economy, for the stock market, would be that the economy declines faster than most people are thinking.
Yeah.
For gold, can I give an ironic answer? For
Yeah.
gold, what concerns me, frankly, Ivan, is that I can't think of a logical argument, a reasonable argument for why gold will decline significantly and stay down for any period of time. And that should make a rational investor nervous. You should always be able to come up with an argument, even if you don't agree with it, and even if you have countervailing arguments that are more powerful. I mean, I can come up with reasons why gold might correct for a short period of time.
Right.
But it's difficult to imagine. I mean, it could happen. Of course, it could happen. But I doubt whether central banks are going to cease their buying of gold for any meaningful period of time. It always ebbs and flows, of course, and it
Hmm.
ebbs and flows with specific countries. China was out of a market, wasn't adding for about 4 or was it 5 months last fall and winter, but
Hmm.
then they came back. So different countries will stand aside for various reasons, for various periods of time. And so you could get central banks in aggregate standing aside. I don't expect that, both because of what the central banks themselves have said. The World Gold Council just put out a survey, well, just last month, I think. They put out a survey of the central banks, and not one said they intended reducing their gold holdings in the next 12 months, and the majority said they intended increasing. Now, this is just what they said, not but the intentions are clear. And frankly, also, if you're selling a dollar and increasing your gold because you're worried about the concentration of the dollar um, in the face of fiscal deficits in the US that just don't seem to be coming under control, and in the face of dollar weaponization, then I would argue that even though the dollar holdings in central banks have come down in the last 5 years from 65% to 47.5% was the last number put out last month.
Hmm.
Well, I would argue the 47.5% is still too much in what that. Um, so that's probably got further to go. And of course, the more dollars you sell, some of it is going to go into gold. So I find it difficult to. So I think the central banks are going to continue to buy. Wealthy investors who are concerned about fiscal deficits, they're going to continue to buy. And North American investors who tend to buy on based on the economic scenario, well, the economic scenario is shifting and shifting fairly rapidly towards the environment that is positive for gold: a slowing economy, lower interest rates, stubborn and higher inflation, and a lower dollar,
Hmm.
which is what we've seen in the last month. That is a perfect environment for gold. So I mean, I do think on balance that we're going to continue to, and when I say gold, I'm including silver. I think on balance we're going to see continued buying around the world, and also including in North America, into the metals.
Welcome to the Cayman Islands, a premier offshore jurisdiction where natural beauty meets financial stability. Here, your wealth is more than secure. It thrives in one of the most trusted and respected financial centers in the world. For over a decade, SWP has been the trusted choice for precious metal investors worldwide. Our purpose-built 6,000 square foot facility sets a new standard in precious metals storage. We are proud to be one of the only vault operators approved by the London Bullion Market Association. Beyond safeguarding your assets, we're committed to making a difference in our community by supporting local causes and events that reflect our values. As we continue to expand and innovate our services, we ensure that your wealth is safe and strategically positioned to shield you from the uncertainties that lie ahead. Strategic wealth preservation, trusted today and ready for tomorrow.
Absolutely. You know, Adrian, right now too, a lot of people have been talking in the precious metals community about, everybody knows that central banks, they've been buying gold, they keep accumulating gold. That's known across the world. But Saudi Arabia recently came out and started buying silver. They bought SLV, so it's the paper derivative of silver, but they started buying silver. What are your thoughts on now central banks like Saudi Arabia buying silver?
Yeah, I think, as you probably know, back in the 70s and 80s, you did have a handful of central banks that owned silver, mostly silver producing countries,
Right.
that own silver. And then that sort of, I mean, I don't know that any central bank held silver, say, in the last 5 years. I may be wrong, but I don't think any of them did, certainly not in meaningful amounts.
Right.
So, yeah, I think this is a very significant move. Because if you're a central bank, and as I say, virtually half of your reserves are in a dollar, and you're nervous about the dollar, apart from the dollar weaponization, you're nervous about the dollar anyway, especially as we move to a bipolar world. To the extent that the US loses its reserve status, then that means the dollar goes lower.
Right.
It doesn't have to lose it completely. We don't have to have China taking over as a reserve currency or anything at all. But to the extent that it loses it, the dollar goes lower. So if you want to continue to reduce the dollar, which is virtually half of your reserve assets,
Hmm.
then you've got to think, do we want to put all of that into gold? Or do we want to start diversifying? And I think we're going to see a little more put into euro, even though the percentage in the euro has gone down over the last 12 months.
Hmm.
But we're going to see some go into the euro and maybe other currencies. I mean, there are some strong currencies around the world, like the Singapore dollar. But how much can a central bank put into currencies like this, like the Singapore dollar? But I mean, I think we'll see a slight but a perceptible increase in other currencies, Canadian dollar, Australian dollar, maybe the yen, but also into other hard assets, and silver, of course, will be the prime beneficiary of that. So yeah, I expect to see more of that.
Now, we've talked about precious metals. We've talked about, the uncertainties and what's concerning you. What are your thoughts on right now, the central banks? Because in Canada, they already moved to lower the interest rates. Now, let's say Jerome Powell and the Fed in the United States moved to lower interest rates. Do you think they are moving too early because of the levels of inflation and unemployment? What are your thoughts?
No, I don't. I think I mean, they've been boxing themselves into a corner for a long time, but they're getting closer and closer and closer to the corner.
Yeah.
And they really are, to use another metaphor, they really are between a rock and a hard place. Because, I mean, clearly in the US, there is no question that the employment picture in the US is deteriorating.
Absolutely.
And as you know, last week the Bureau of Labor Statistics came out and said, "Oops, 911,000 jobs that we said were added to the economy over the last 12 months, ending March, didn't actually exist."
That's
I
crazy.
mean, this is just unbelievable.
That's crazy.
Yeah. And so anyway, the labor situation is clearly deteriorating. Even Powell admits now that he can't use the words very solid to describe the labor market. And so they really are boxed into this corner. So as the labor situation in particular, and the economy in general, but particularly the labor situation deteriorates, the central banks are much more likely to err in favor of helping the employment picture, even at the risk of hurting inflation. So yeah, I think we're going to see that. My own view is that the Fed probably should have cut 0.25% at the last meeting, or
Yeah.
even before. But I think, I mean, a couple of things. The Fed this Fed, the last Fed under Bernanke, under Yellen, and then before that with Bernanke, have emphasized that they're data dependent. When you're data dependent, that means that you are backward looking. I mean,
Yeah.
that's what you can't be data dependent and looking forward. You are inevitably looking back.
Right.
And when you're looking back, you have some reports that come out weekly. But when you're looking back, and the main thing you're looking at is new jobs creation, which is a monthly number, which is revised twice. And those revisions have been, for the last few years, very, very significant. You really don't have even the government's estimate of employment. Forget whether that's accurate or not. You don't even have a clear picture of what the government itself thinks about employment creation until 3 months after the event.
Oh, it's too late.
3 months late, you know, your monetary response is going to be late. And I think that was clearly the case with employment. There were a lot of smart people, as well as myself, who for months have been saying that the employment picture is not as strong in the US as the headlines being new jobs creation and the employment number. Those are the headlines, those are the central numbers. But again, I've been saying for months now, but if you look under the hood, things were clearly not as solid as those numbers would suggest. You know, and we've talked about this before, but when literally the majority of your new jobs are either part-time or government, that's not a solid employment picture.
No.
When the majority, something like 75% of the people who accepted a part-time job in surveys said that they only took the part-time job because they couldn't find a full-time job, that's not a solid employment picture.
No.
And all the Fed had to do was first of all, put some of those 400 PhDs who hang out at the Eccles building in Washington, put some of them onto reading the Fed's own beige book. I mean, all of the Fed regions put out what's called the beige book, where they talk to businesses in their region.
Okay.
They only had to read the beige book to find that most companies did not think the employment picture was as solid as the numbers suggest. And frankly, some of those people could have just sat down and picked up the telephone and listened to conference calls. Obviously, when you listen to a conference call of a company, you're listening to what the company thinks, not what they're doing. But I would argue that in aggregate, listening to what CEOs think is going to happen to their own businesses in the next few months and year is probably a pretty reliable indicator of what's likely to happen.
Absolutely. Adrian, you're absolutely spot on with all of these topics. It's an unrealistic picture, especially for the jobs number and the part-time portion of it. Now, before you go, Adrian, I really want people to connect with you. I'm going to put your links in the description below. Can you give us a brief kind of, where can people find you on social media? Do they just go to the Adrian Day Management website? Where can they find you?
Yeah, well, look, the website's the best place to go. That's adrianday.com, and that talks about our newsletter as well as the money management. Two separate businesses, but different people really want different things.
Right.
We're not on social media. Frankly, for compliance reasons, I probably will have to give up at some point and get onto X, but the SEC in antediluvian fashion, I think they only acknowledged that social media existed a few years ago, but the compliance rules are kind of burdensome.
Yeah, they're strict.
So I'm not on social media. But they can see stuff on the website, and it includes not only your wonderful interviews, but even a few good interviews from other people, as well as information, on our money management services, as well as on our newsletter.
Absolutely. I highly, what's that, Adrian?
Thank you for
Oh,
that.
no, no, no problem. I highly recommend everyone watching this right now. Please go to adrianday.com. I'm going to put the links in the description below. So, everyone, please, I highly recommend you follow Adrian's work. Please check it out. Check out the website because it's a wealth of knowledge and what they offer there is really incredible. But, Adrian, thank you so much for coming down and speaking to us. I'm so happy to have you on every time you do come on. And as the market develops in the future, I'd love to have you back on soon.
No, absolutely. Thank you. I
Talk.
appreciate it. Thank you, Ivan.
No problem, Adrian. Talk to you soon.
Okay, bye.